Somewhere out there, a stranger owns your mortgage. Not your bank, a stranger. A pension fund in another state, an investor on another continent, somebody you will never meet and never speak to. And your bank sold you to that stranger within about a month of handing you the keys. And it never once mentioned it to you. I know because I was part of the machine that did the selling. And when I first walked into the mortgage business in 2007, I didn't understand this either. I thought a mortgage was a deal between you and the bank that lent you the money. That is almost never what it is. Your loan gets made, and then your loan gets sold, sliced up, and piped out to people who bought the right to your monthly payment. And the whole thing happens over your head while you're still figuring out which box the mailbox key opens. Today I'm going to show you where your mortgage actually goes after you sign, and why it matters far more than it sounds. Because the exact same machine that turned your debt into a product to be traded is now being pointed at everything you own. And there's one thing it can't touch. Let me take you back to 2007. I'd spent 3 years arranging car loans at a dealership, and I thought I understood lending cold. An old colleague pulled me into the mortgage business, and I walked in confident. Same game, bigger numbers, right? Here was my first tell that I knew nothing. I assumed that when a bank lends you $250,000, the bank keeps that loan, that they'd carry it for 30 years and collect your payments, like a landlord collecting rent. That's what a normal person assumes. It's completely wrong. In most cases, the bank that originates your mortgage doesn't want to hold it for 30 years at all. It wants its money back in 30 days, so it can turn around and do it again. And the way it gets its money back is the part almost nobody understands. So let me walk you through it, slowly, because this is where the machine gets bigger than one desk. Remember what we established last time. The bank creates the loan out of nothing. It types the money into existence against your signature. Good. Now it's holding your promise to pay $240,000 over 30 years. That promise is valuable, but it's slow. 30 years is a long time to wait. So here's what they do. They take your loan and they bundle it together with thousands of other people's loans. Your neighbors, a stranger's in Ohio, a couple's in Florida, into one giant pool. Then they chop that pool into slices and sell the slices to investors as a product. It's called a mortgage-backed security. When you buy a slice, you're buying the right to a piece of all those monthly payments flowing in, including yours. Picture a lemonade stand that signed up 2,000 customers to pay $1 a week for the next 30 years. The kid running the stand doesn't want to wait 30 years to collect, so he sells tickets today. Tickets that say you get the next 30 years of these payments to investors for a big lump sum right now. He gets his cash immediately. The investors get your weekly dollar for the next 3 decades. Your mortgage is the weekly dollar. You are a line item in somebody's ticket. That is what happened to your loan. Your payment doesn't really go to the bank anymore. It gets collected by a servicer, sliced, and routed out to whoever bought the ticket. And if that already changes how you see the word mortgage, hold on, because I'm going to show you how this same trick is now being run on the assets you're counting on for retirement, not just your debts. I keep a running breakdown of exactly who ends up owning what in this system on my site, and I'll point you to it in a minute. First, finish the picture, because the why is the important part. Why go to all this trouble? Because it makes the machine spin faster, and speed is the entire game. Think about it from the bank's side. If they lend you $240,000 and then wait 30 years to get it back, that money is stuck. They can't lend it again until you've paid it off. But if they sell your loan next month and get the money back right away, they can immediately create the next loan, and the next, and the next. Each one new money typed into existence. Each one sold off to free up the cash to do it again. It's a conveyor belt. Originate, sell. Originate, sell. The bank stops being a lender that holds your loan and becomes a factory that manufactures loans and ships them out the door. And every loan shipped out is more debt in the world, which, as we covered last time, means more dollars in the world, which means the ones sitting in your savings account are worth a little less. The faster the belt runs, the faster your money gets diluted. Securitization is the thing that let them run the belt at full speed. Now, there's a rot built into this, and it's the seed of a disaster I'm going to give a whole episode to. When the person making the loan doesn't have to keep the loan, they stop caring whether the loan is any good. Why would they? They're getting paid to originate it and pass it on. Somebody down the line eats the risk. Hold that thought. In a later episode, I'll show you exactly how that rot detonated in 2008. For today, stay with where the money goes. Here's what this costs you. And it's not only about mortgages. It's about a lie you've been told your whole financial life. That you have a relationship with the institutions holding your money. You don't. In a securitized system, nobody in the chain actually knows you or has a stake in you. Your loan is a line in a spreadsheet owned by someone who's never heard your name. And here's the thing to sit with. The money you save works exactly the same way. The dollars in your bank account aren't sitting in a drawer with your name on them. The bank took them and lent them out and turned them into more of these products. Your savings are an entry on their books, a promise they'll give it back if you ask. Legally, once you deposit money, it's not yours anymore. You're an unsecured creditor of the bank. You're a line item, same as your mortgage. That's the quiet truth under this whole system. Almost everything you think you own is actually a claim, a promise from somebody else to give you something later. And a promise is only as good as the person making it, and only worth what the dollars are worth when they finally pay you back. Now here's why I dragged you through all of this, because it's about to matter more than it ever has. The exact machine they built for mortgages, take a thing, turn it into a tradable slice, sell it to strangers, is right now being pointed at everything else you own. They call it tokenization. The biggest financial plumbing companies in the world are working to put stocks, bonds, and real estate on-chain, to turn them into digital tokens that can be sliced and traded the way your mortgage was. Your shares, your treasury bonds, even real estate itself, wrapped and reissued as tokens. And when that happens, you don't hold the thing anymore. You hold a token that represents a claim on the thing, issued by an institution, and that institution can define what the token does. Freeze it, reissue it, control it. It's the mortgage trick. Run on your assets instead of your debts. Another layer added on top of you. And every single layer in that stack has an issuer, a company, a custodian, a government, a man who can make more, change the rules, or pull the plug. Your ownership becomes a promise about a promise about a promise. So ask the question again, the one that runs through this whole series. Who can make more of this? Only now ask a sharper version of it. When I hold this thing, am I holding the actual thing? Or am I holding somebody's IOU for it? Your mortgage-backed security, an IOU. Your bank balance, an IOU. Your tokenized stock, an IOU on an IOU. Every one of them is a layer, a claim, a slice of somebody else's promise. And then there's Bitcoin. Bitcoin is not a layer in anyone's stack. It's not a slice of a bundle. It's not a claim on an asset held by a custodian who can reissue it. It's not a promise from an institution that can go bankrupt or change the terms. When you hold your own Bitcoin, you hold the actual asset, the whole thing, not a ticket to it. And there is no servicer, no issuer, no pool, no tranche sitting between you and it. 21 million, and not one of them is somebody else's debt. In a financial system that is nothing but stacked promises, it is the one thing that is not a promise. It just is what it is. That's not a small distinction. Everything I sold, sliced, and shipped for years was somebody's promise dressed up as an asset. Bitcoin is the first asset I ever found that isn't dressed up as anything. There's nothing underneath it to default. I told you I keep a breakdown of who really owns what in this system. It's at timtalksfinance.com/members. Plain language walkthroughs of how your assets are being wrapped and reissued, and where self-custody Bitcoin sits outside all of it. It's part of the membership, and I built it because the people running these layers are counting on you not knowing they're there. Go see it after this. I'm not telling you to sell your house, and I'm not telling you what Bitcoin does next quarter. Nobody knows that. What I'm telling you is a structural fact you can check yourself. In a world racing to turn everything you own into a slice of somebody else's product, exactly one asset refuses to be a slice of anything. You can decide how much that's worth to you. That's a probability to weigh, not a prophecy to swallow. I'm just making sure you know the option is sitting there, and that you know what it's actually protecting you from. So the next time you write that mortgage payment, remember where it's really going. Not to your bank. Out the door, sliced up, routed to strangers who bought the right to your signature. Because your debt was turned into a product the month you signed. That's the machine. It is very good at turning you into a line item. And the one move it can't make, the one asset it can't slice, wrap, reissue, or sell out from under you, is the one with no issuer and no layer on top of it. Bitcoin doesn't need the machine's permission to be yours, because there's no one in the middle to ask. In a system built entirely out of other people's promises, that is the whole reason it exists. Tools to see all of this in your own money are at timtalksfinance.com/members. Next episode, I'm taking you all the way down to the desk to show you the single strangest thing I learned in 17 years. The question about interest I could not answer for a year, and what the answer told me about why this can never stop. I'm Tim. I'll see you there.